The market's taken a beating, and right now we're sitting at a critical inflection point. So here's a tactical framework for how to think about the next 1 to 2 weeks.
First, let's quantify the damage. The S&P 500 has wiped out over $2.4 trillion in market value just since late October. That's a huge number.
And you can see that fear priced right into the VIX. It briefly shot up to 28, which was a level that screams acute risk aversion. People are paying up for protection.
Sentiment has absolutely collapsed. The fear and greed index cratered to a reading of 6. Now that's a level of extreme fear we haven't seen since the April bottom, and historically, that often precedes a pretty sharp contrarian bounce.
So, all of this sets up a major tug of war. You got a direct conflict between some very legitimate macro fears and a really powerful underlying market structure.
Let's break this down because it's really the core of the issue. On one side, you have this fundamental, bearish pressure from real economic headwinds. And on the other, you've got some serious structural support from how the market is positioned.
On the bearish side, the drivers are pretty clear. First, you've got significant consumer weakness showing up in the data. Second, there's liquidity stress bubbling up in tech with bond spreads starting to widen. And third, just this persistent uncertainty around what the Fed is going to do next.
But on the flip side, there are 3 powerful factors that could provide a floor here. 1, that extreme sentiment we just talked about. The fear and greed index is at pure capitulation levels. 2, you have a strong institutional incentive to mark up their books heading into year-end. And 3, and this is a big one, a massive options put wall sitting at a key technical level. So this pressure has to break somewhere, right? The whole thing is going to come down to a few key levels in some very specific assets.
Okay, 3 levels matter most right now. First, S&P at 4,100. This is the big one. It's the location of that massive put support wall, and you can think of it as a line in the sand, where big options positions might force dealers to start buying futures to hedge their risk, which can create a floor. Second, you have NVDA at 180. It's basically the linchpin for the entire AI narrative. And third, the weekly 20 moving average on the QQQ. Whether these levels hold or fail will likely decide the market's next big move.
All right, before we map out the scenarios, we got to do the standard disclaimer. This content is for educational purposes only. It just pulls together public sources to help you stay informed and sharpen your own decision-making. So please, do your own research. This is not financial advice. And hey, one more quick thing before we dive in. If this kind of breakdown is helpful for you, a like and subscribe really helps the channel. Your support is genuinely appreciated. Okay, let's map out the possibilities.
So, let's outline our base case. This scenario is built almost entirely on that massive option structure we see heading into the monthly expiration.
The most probable outcome here, just given the sheer size of that put wall, is a choppy defense of S&P 4,100. Now, this wouldn't be a straight shot up, but more of a grind higher as institutions work to defend that level into the end of the year. Okay, now for the bull case. This is the alternative scenario where some kind of catalyst comes in and ignites a much sharper, much more aggressive rally.
So what would trigger this? You'd need a dovish surprise, either from economic data or a clear signal from the Fed. That would basically validate that the extreme fear we saw was a major bottom, leading to a rapid unwind of short positions and a chase into year-end.
And finally, the bear case. This is what happens if those underlying fundamental weaknesses just completely overwhelm the technical and structural support we've been talking about.
This one's pretty simple. A decisive break below S&P 4,100 and that weekly 20 moving average would completely invalidate the bounce thesis. And from there, the door would really be open for a much deeper correction.
So, with those scenarios on the table, here are 3 potential risk-defined option structures to think about for this 1 to 2 week horizon.
First up, a bull put spread on SPY. The whole thesis here is that the put wall at the 4,100 level holds through expiration. The strategy is designed to profit from that high implied volatility and time decay, as long as SPY stays above your short strike.
Second, a call debit spread on NVDA. With the stock testing that critical 180 support level, this is a defined risk way to play for a bounce. Your maximum loss is capped at the premium you pay, which gives you some really nice leveraged upside if that level holds and the stock recovers.
And third, for those of you with low conviction, or maybe you're just looking to hedge your existing long exposure, a longer-dated put on QQQ can provide protection against that bear case scenario. If those key support levels break, this position can help mitigate losses in your portfolio.
Now, a very important reminder, options trading involves substantial risk.
Your capital is at risk, losses can exceed the premium you pay, and disciplined risk management is absolutely paramount.
And to wrap it up, this is not trading advice. It's just a market update to keep you informed. All markets carry risk, so trade your own plan, manage your downside, and always verify your own data.
So this is really the critical question for the next 2 weeks. Is this extreme fear a true capitulation low that's setting up a year-end rally? Or is it just a pause before the fundamentals take over and drive the next leg down? That's the decision point we're at right now.